Good evening. On a completely different note, we're in Spain and mining. We are a company that's developing Europe's largest uranium mine. And over the last 12 months, we've advanced the project to the point where we're now in development. And this is a period of time when the uranium price is very low. So what we're doing is bringing uranium projects into production right at the bottom of the uranium price cycle, but we can make very good money at the bottom. We're located 2.5 hours west of Madrid in a place called Salamanca, just north of the university town. It's a historic uranium mining area. This is where Spain built its nuclear industry in the 1970s. They stopped mining uranium 20 years ago, and we've picked up the tenements and redeveloped them. And it's big. You know, this asset that we're developing now will not just be Europe's biggest uranium mine, it'll be number 8 in the world in terms of annual production, and we are the only uranium mine in the world being developed, major uranium mine being developed today. The team we have, they developed 3 major projects in Spain before. This is their 4th consecutive mine in Spain, so they know what they're doing. And the evidence is 12 months ago we started. We'd been going for 10 years. There's $60 million put into this project. I was appointed just over 12 months ago, and we've gone from 0 to pouring concrete. In fact, the story about Spain is there's all sorts of things you're supposed not to be able to do in Spain, and one of the classics one is you can't do anything in August. Well, like many of you, I was on holiday in Spain in August, except for, unlike you, I was pouring concrete for the first pour of concrete for the development of this mine in the middle of August. So we mobilized contractors, full executive team, everybody on site. So Spain's very much open for business, and many of the stereotypes that exist in the past don't apply now because it's very, very dynamic. But the other stereotype you know about Spain is very true. This is an area west of Salamanca where the local unemployment rates are around 20% overall, and youth unemployment's around 50%. So the first 200 jobs we've advertised, we have over 20,000 fully documented applicants. To give you some idea of the sort of demand. And what we're creating is in full construction next year, we'll have 700 people and temporary contractors on site, and then a permanent workforce of 454, which in turn will generate around 2,000 indirect jobs. So we're going to have a very, very positive impact on a community that's been devastated by long-term unemployment and depopulation. People have left this area as empty houses. So we're going to rejuvenate a local community. And part of that is you're all very aware of the issues of globalization. People are making investments in a community, but the benefits can sometimes flow to London or Madrid or New York, not necessarily to the community. So what we've done, we've reached agreements with the local communities where we pay royalties direct to the communities, preferential jobs for the local employees, training for local employees, all the normal stuff, investing in the local cultural community, even down to the point where we've invested local Wi-Fi, free Wi-Fi in the local villages. So very much give a sense that if we're going to be in your community, we're going to be a good neighbor and a good business partner. The reason why the mine's going ahead, as I mentioned, when the uranium prices are so low, is we've got 2 characteristics that are generally fairly rare. I think every single mining company you will ever hear presented to you will tell you their lowest quartile operating costs. But normally what goes with that is something else, and that's a high capital cost and also a long lead time to production. So we have this rare combination of we are right at the bottom of the world cost curve in terms of operating costs. At $100 million of the capital, we're extremely low capital cost, and we are developing it now. So we've got that rare combination of all those 3 things. You say, okay, Paul, that's fine. I hear you. Why? Why is it that your asset, the Salamanca asset, is able to do that? Well, there's 2 reasons. One is we have this asset called Zona 7. This is the deposits that accounts for half our ore body half our resources we're going to mine. It's 30 million pounds out of the 60 million pounds we're initially going to mine. And it's very shallow. It's less than 100 meters from surface. In fact, Mike on a good day could dig down to the top of the ore body. It's only 4 meters below the surface. Very high grade, good recovery. But the other side of it is that goes with very low capital costs. A comparable project in Australia would cost $150 million more. We're only $100 million up front. And you ask why? Well, the answer is partly because you've paid for it. Because basically the Spanish have spent the last decade drawing down money from the European Union, building roads, railways, power lines, everything you want. So you arrive at this mine, and it's got the best infrastructure you've ever seen, and it's an ore body very close to the surface. So that you put those two things together, and that's why this asset is probably today going to be the lowest cost producer of uranium in the world. And so here we are with the uranium price, and the spot price is the blue line. The yellow lines along the bottom are what we're going to produce it at, and these are all independently verified definitive feasibility study numbers. And basically, you can see the spot price is falling gloriously. You can see it's collapsing, and it will go lower. But just on the right there's that orange line going the other way. And what the difference between two lines is, the spot price is today's price. It's what people go out and buy the little bits of uranium they need now. And the orange line is what's called the contract or the term price. And that's what the utilities, if you're running a nuclear utility somewhere in the US, you buy 5 or 10 or 15-year contracts. So that price is considerably higher than the spot. So we're now signing contracts for these term contracts. And we've announced the first one. The first one we've signed is at $41. So we can produce uranium and sell into that, we can produce uranium at $15 a pound and sell it into a long-term contract at $41 a pound. And we're doing more of those contracts. So clearly a very, very profitable business to be in. And what that generates is the yellow bars are the amounts of uranium we're going to produce a year. And this is from our definitive feasibility study. This is all independently verified and signed off by the various people have to. But clearly you can see we're a very strong cash generator. So for those of you who are shareholders in Central Asia Metals, you'll know Nick Clark. He has this kind of model as well. He calls himself a very boring company because all he does is build a mine, leach the ore, sell the copper, and produce cash, and then pay, generates the cash, and then he pays it in terms of dividends. So if you like, we're trying to emulate what Nick Clark's done and be really, really boring and dull and just do that. That's our target. Some people ask me about the uranium price and what's going on. I can explain it. And if I can step out of camera shot just for a moment. Basically, most people are aware the uranium price went ballistic in 2006 and 2007. And you say, well, why did that happen? Well, these yellow bars are what's called long-term contracting. This is when the utilities enter into long-term contracts. And you can see during that period, there wasn't much going on. And suddenly the uranium price went ballistic and they panicked. And they put in 3 to 5 to 8 year contracts going forward. And now they're doing very, 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 very little. So you say, that's interesting. Here is all the world's nuclear reactors not contracting. What's going to happen next? Well, so basically, next year, 2017, this is all the US reactors, all the European reactors are basically covered for uranium supply, about nearly 100%. But you can see what happens very quickly. Over 5 years, the Americans go down to 20% coverage, and about 2 years later, the European reactors go. So you've got 350 reactors around the world all going to come back into the market and recontract for uranium over the next 5 years. But they've got a problem because they're going to be competing with the Chinese. The Chinese are spending $570 billion. They're building 21 reactors at any point in time. They're commissioning 7 a year. We spend 7 years worrying about Hinkley. They commission 7 every year. every year. And they've now got to do more. They've got to do 60 reactors. This is, we worry about reactors at Hinkley. These guys, within Shanghai, there's 1, 2, 3, 4, 5, 6, 7, 8, 10. There's like 10 and 2 more to go within 2 hours of Shanghai. So it's a fundamental part of their decarbonisation strategy. That's how they're going to wean themselves off coal, is to have nuclear. So they've got 60 new reactors. So what's going to happen is, if they meet their requirements, if they build those 60, which we think they will, then there's going to be a 5-fold increase in the demand for uranium. At the same time as the US and the EU have got to recontract. And just one point to be aware of, 3/4 of the supply of uranium comes from fairly dodgy places like Russia, Kazakhstan, and Niger. But about 2/3 of the demand comes from OECD, comes from Europe and the US. So here's we come along and say, we're going to build this uranium mine, and it's in the heart of the European Union, heart of the OECD. So if you're a US utility, it doesn't make much sense to be getting your uranium from Kazakhstan or Russia or Niger when you've got somebody in the European Union. So I can share with you, we're being bombarded by the OECD consumers saying, we'd love to have somebody to supply us from the European Union. So for that reason alone, diversification, we are very, very popular at the moment. And of course, the Chinese, if you're spending $570 billion building 60 reactors, they have a policy where they get 1/3 of their uranium from domestic, 1/3 from market, which is their euphemism. They get it from Kazakhstan, and then 1/3 from investing in assets around the world. So we're now sort of top of the list for them. They didn't spend much. Got $570 billion to spend, but we're keeping this present in the box because the box is actually more valuable than the present inside. But anyway, there was the significance of starting the process of the negotiation with us. So they're basically saying, you guys are the next cab off the rank. We would like to see if we can do business with you to supply us with uranium. So where we end up, as I mentioned, we've got, this is our resources, measured and indicated, 60 million pounds, and I mentioned half of that is in this Zona 7 deposit. And then beyond that, we've got 30 million pounds in what's called inferred resources, which we have to drill and convert into measured and indicated. So as long as we're spending money every year converting that, then we should be able to maintain £4.5 million a year going forward, which is what the utilities want. They want steady state, long-term, reliable supply from the heart of the European Union, and that's what we're trying to achieve. And then this is the areas where we've got more exploration. We're drilling at the moment, and I mentioned this is the Zona 7 deposit. This is one that's the one that makes all the money for us. So we've drilled through it, and we've hit stuff directly underneath, which is beyond that 90 million pounds, and it keeps going. So we think that Zona 7 itself is going to get bigger, so we think we'll make that overall 90 million pounds more. And then finally, the people who've sort of followed us and bought the stock and driven the stock up have been all institutional. So many of you will know them, so sort of Fidelity been buying, BlackRock, this is their UK equities, River Mercantile, Phil Rodrigues, you guys may know, Majedi, Richard Staveley. So basically it's the UK generalists buying it. And what they're buying is a development asset in Europe, in part because they see it's at the bottom of the cycle and strong cash flow. But there's one other factor that we've got that appeals to a generalist. The fact is all our costs are in euros and all our revenue stream is in US dollars. So basically they're saying it's a sort of Draghi easing, Yellen tightening. They see that that's a nice spread to have. And that's basically the story. The only thing I draw your attention to is a few of you might be Anglo-Pacific shareholders. This is Julian Sugar. He's a major shareholder and he likes what we're doing. So anyway, well, thank you very much for your time.
Questions, anybody? Ooh, sure there's some hidden away there. Oh, there's one over there.
Congratulations on what you've achieved so far. I think it's the most impressive looking investment prospect I've ever witnessed, so it's really exciting.
Thank you.
The first question is, with the current drilling that's underway, what phase is that at the moment, and when do you anticipate to publish results from that?
Good question. It's very early stage. It's drilling under Zona 7 is we're getting good results and we've got more to go. And without getting too geological about it, is we're trying to work out in which direction it's going. And we don't know yet. So it will take probably 2 or 3 more rounds of drilling before we've got anything sort of tangible, so we can say to you that we've got something, you know, meaningful in terms of resource. So we'll keep publishing results as we go. What it means in terms of resource, I would guess, sort of first quarter, second quarter next year. It'll just take time to come out.
And if you suddenly find that you've got much, much more uranium in the ground than originally planned at the time of doing the DFS, what are the limiting factors that are setting is it 4.4 million pounds per annum? And if the price does spike to ridiculous levels, is there anything can be done to sort of ease those bottlenecks and ramp up the supply?
In theory, we could just make the plant bigger. But to be frank with you, we probably won't, because what's attractive to the utilities is if we can show long-term steady-state production. And that's why when I show it, we can do £5 million a year, but I'm just showing steady-state 4.4, because that's what means that they will come to us. And I didn't emphasize it, but if they do come to us, they come into us preferentially. They'll actually pay us a premium because we're OECD, but as long as they're comfortable that we're steady state. So I think it'll take a lot for us to move from that long. I know it's boring and it doesn't give a better result, but it's a sort of boring steady state, keep maintaining that production.
Thanks.
Other questions, anybody? Coming down the front.
Do you forward sell all of your production, or do you keep some back which you could sell at spot, just in case there's another super spike in the future?
The utilities want to take all of ours at current price, as you can imagine, for exactly the point you're making. So within the contracts, as part of it is what's called fixed and escalating. So it might be today's price and escalated at 3% a year. And part of it is what's called open to market, which will have a collar, which will be a base price and an up price. So the typical utility will say, we will put a cap on it at $60 a pound and a floor at, say, 30, something like that. So the utilities are very, very aware that they don't want to get caught by what you're talking about, but they're equally aware that we want to participate in that. So it's a bit of a wrestle. And I can't give you a perfect answer because each utility is slightly different. So yes, we want to get as much exposure as we can, but at the same time, we want to be able to guarantee that we can pay off our capital and pay back the initial phase. So during the initial phase, we'll probably lock in as much as we can, pay off all our capital, pay off all our debt. And as you go forward, you get more and more market exposure, hopefully, with uranium price rising.
And you're going to be very cash generative in the future. What are the plans for that cash? Are you going to distribute it as dividends?
Going to give it to me. No, I'm a shareholder, so and I refer to Central Asia Metals as we have no M&A ambitions, no expansions. We couldn't be any more boring and dull. All we're trying to do is what Nick did with Central Asia Metals, is just develop this asset. We have no other agenda. That's it, end of story. And if that then generates the numbers we're talking about, which we hope it will, then the logical outcome of that would be, beyond any money we need for exploration, would be to give the rest back. As dividends, yeah. Yeah.
In fact, Nick was here about a month ago.
Was he really boring?
No, he wasn't.
Was he very boring? I mean, it's just...
but
that's all. I mean, he's really dull. He's gone to Kazakhstan. He's built a copper mine. He's paid loads of dividends back. I mean, he paid his market cap back in dividends in, I don't know what it is, sort of 2-3 years or something. So how boring is that? I mean,
he's running out of resources there, so he's now looking to expand into, I think Brazil is the way they're looking. So
he's done absolutely fantastic
fascinating
job.
Model. Yeah.
Great job.
Any other questions? From a financial point of view, are you fully funded for the full development, or are you going to do this in phases?
No, we don't. No, we've only got $10 million in the bank, and this is a $100 million investment. So we have quite a few irons in the fire in terms of developing the asset. I kind of flagged one of them clearly, and we've announced this in the quarterly. Clearly, having a Chinese partner with $570 billion in the bank would be useful. In terms
and your background, I think I seem to remember you
I've had
in China, so hence the link, I suppose. And just a pure process. Do you refine the uranium on the site, or does it go away, or what?
No, we produce a thing called yellow cake, which is just a calcined. We just leach it and calcine it, and basically goes in a drum, the classic drum, and then it gets taken on a truck to a place called Comiohex in France, and it's sold to Areva. So never goes near a ship, never goes anywhere. It's a sort of, I don't know, I think it's a sort of 15-hour truck drive to the middle of France, and Areva, we sell it on contract to Areva. So if CNNC want to buy our uranium, we basically take it to Comiohex and put it on account there, and they can buy it on account, and then they've got uranium somewhere else they can sell somewhere else. So it's basically what I'm saying is we don't have to ship it around the world. It just goes to France.
Any questions, anybody? No? Paul, thank you very much indeed.
Thanks for your time.
Thanks. And finally, can I welcome Michael back to you?